Well, good morning, everyone. This is Dan, and today is December 4th. And I just want to take a quick look around some of the markets and some of the most recent mortgage information that's come out. And so let's go right to it. First thing we have on tap for you today is the Black Knight uh, report that came out this morning. And let's get to it here. And so, what we're looking at is the mortgage monitor for December. And bear with me for just a moment, but I gotta get over to the, there we go. Yeah, we're good. So we'll get over to the Black Knight report, which is the mortgage monitor for December. December 4th just came out this morning, and just kind of take a look at some of the key points. Despite clear signs of slowing, housing prices have hit yet another seasonally adjusted high in October, with unadjusted growth, annual growth rising to 4.6%, up from 4.2% in September. Recent home price gains have returned tappable equity to within 3% of its 2022 peak, contributing to a modest increase in equity withdrawals in Q3. Just 0.41% of tappable equity available at the beginning of the quarter, less than 1%, was withdrawn in Q3, some 55% below the average withdrawal rate that we saw from 2010 to 2021, which is really interesting. So, folks are familiar with refinancing to do a cash out refinance, and the higher rates are dissuading them from doing so. That's basically the takeaway, and they really haven't want to go into a home equity line of credit. An estimated $54 billion in equity withdrawals were forgone in Q3 as rising interest rates increased the cost of equity utilization, with an aggregate of $250 billion missing over the last 18 months. Despite compressed volumes, cash outs continue to fuel what is left of the refinance market, accounting for 92% of activity, with borrowers withdrawing a record $104,000 on average. And purchase lending continues to dominate the overall market, driving 86% of all first lien lending in Q3, with roughly 75% of 2024 originations expected to come from purchase loans. That's interesting. Rising rates continue to put pressure on home buyers, with debt to income ratios on purchase loans hitting multi-year highs in October. Data also suggests tightening lending criteria as credit scores for conventional FHA and VA loans all hit series highs, with FHA credit scores up 14% year over year. So credit scores are hanging in there right now and actually improving. While foreclosure starts rose in October, near-term equity risks remain muted due to a combination of historically low serious delinquency rates and strong equity positions among loans. So some interesting information coming in from Black Knight. Basically that there's a lot of untapped equity. And let's take a look at some of the charts. I always like going to the chart section. So let's take a look here. And we're going to have to stop sharing this. There we go. And we're going to need to start resharing the screen. Let's take a look here. Give me just a minute there. Let's see what we got. Sorry about the delay. There we go. And just a couple charts here real quick. Okay, just a couple quick charts. The delinquency rate is down 3 bips. Foreclosure starts are up 30%. That's interesting. Foreclosure starts jumped to their highest level in 18 months. Loan held in active foreclosure has inched up, but remained more than 25% below pre-pandemic levels. So we're starting to normalize. And then prepayment activity is down. So we're starting to see credit tightening just a bit. And you could definitely see that in some of these numbers. Let's move on to what the market's doing today real quick. We'll share. We'll go to the markets here real quick. And there we go. And we can see right now the mortgage rates, the mortgage markets are up 20 bips, or excuse me, are down 20 bips with the U.S. Treasury up 6 basis points. So let's go to see if we can find the chart here. Go down to it, and we can kind of see what's going on. We had a nice move on Friday, obviously. A bit of a reversal today. Wouldn't be surprised if to see things come back down to approximately the 101.50 level and consolidate there for a couple days as we're kind of waiting for the Friday employment report that's going to be coming out. That's a big report, so keep an eye on that. But in the meantime, we're probably going to see some consolidation of rates, meaning they've made a big move higher in terms of mortgage-backed securities, a big move lower, for example, in 10-year treasuries. Let's go to that chart so you can see the 10-year treasuries have come down quite a bit. And we're probably going to see a little bit of a reversal for the next 2 days, up until Wednesday, maybe into Thursday, in anticipation of the employment report on Friday. Nobody likes to be caught with positions open going into the employment report. So it wouldn't be surprising to see a little bit of give back going into the report. So that's about all we're looking at right now today. The big news is going to come on Friday, and we'll be covering it for you. I'm going to try to be putting these reports out first thing in the morning, approximately this time every day. And thanks for joining me. Have a great day.